Hi, my name is Chris Tubby, and this is part one of two parts. This is where I look at the macro outlook, and the second part is where I do some technical analysis for you. I just do this just to help you prepare for the week ahead, so I hope you enjoy it. Okay, so last week, goodness, just start. So this is my macro outlook. So last week, Wall Street ended the week with the S&P hitting a record high for the first time for a couple of years, actually. And there's just expectations of this AI boom that's still going on, and impacting almost every industry. And that pushed the market higher as we sort of went through the week, and it finished on Friday, pretty much at its highs, touching 4,800. So amazing. And of course, data is suggesting for the US that there's going to be that soft landing that a lot of people have doubted. I definitely haven't been one of them, as you would know if you sort of listened to any of my previous stuff. So, and of course, with consumer sentiment now, it's hitting a 2-year high, so it's understandable. That sort of correlates with the stock, the S&P hitting a 2-year high. Consumer sentiment's there as well. So in the US, things are strong at the moment. And of course, you've got to appreciate that they put so much stimulus into the economy during and after COVID. We're talking $6-8 trillion. So a lot of that is still floating around the system, despite the fact that the central bank, the Fed's doing its QT now to try and drain some of that out, but they're doing it very slowly. And then if we move on and we sort of look at the geopolitical landscape, it's a danger to the markets. It's just a danger to the world at the moment. There seems to be more and more tension coming a lot into just our lives, isn't there, really? But sort of economically, the next test is going to be for the stocks, and that will be on Friday, I think, when the Fed's favourite inflation indicator, PCE, comes out. And those treasuries are heading back up again. They're rising towards that 4.25% level. Now, despite the tension in the Red Sea, I mean, oil was steady, but definitely not spiking. WTI seems to be ranging at the moment between about $71 and $75. Bitcoin dropped after reaching 49,000. That was after the ETFs were approved. There was about 11 of them from day one. And there it dropped all the way down to about 41,000. So, one of those instances of buy the rumour and sell the fact by the looks of it. But of course, it's the same thing when the CME launched the futures, that there was a sell-off, and maybe it's because it's much cheaper for people that want to get short of it, people that want to sell it, to do it without it being very expensive for them, because it's the same if you're long or short, basically. But however, the fact that it's come down to that 41,000 is impacting Grayscale's Bitcoin Trust. That's its asset value has dropped around 5 billion because of the lower prices, but also some outflows. So some have been cashing out from that. So okay, now we're sort of what's going to happen with central banks. So everyone's expecting rate cuts this year, and these meetings are going to be very interesting. And when we're looking at them, the statements and the press conferences, the forward guidance is all the traders are going to be looking at this, because we're going to be looking for clues of when rates are likely to start falling. And I think the timing of that is going to differ between countries, because they've got very contrasting economic conditions. So this Thursday we have the ECB rate decision, and it's going to be difficult for them, I think, to offer much in the way of forward guidance. Apart from any cuts, are going to be data driven. Inflation certainly isn't at their 2% target yet. In fact, it has turned a little bit higher, and that may not be the end of it. So the Eurozone's still suffering from slow growth. I mean, Germany, that's usually the powerhouse of the EU, is still almost the weakest link. And that could remain the case unless something like China's economy picks up pace and consumer demand increases. And Germany hasn't really invested in its own infrastructure. There's also sort of a lot of unrest the way the country is being run by the government. There was a lot of protests this weekend, in fact. And then, of course, if we look at things globally, including in the EU, there's numerous elections this year. I mean, there's over 40 around the world. So, apart from the ECB rate decision, we've got the Bank of Japan also meeting to decide on rates and also the yield curve control that they introduced some time ago. Inflation there looks as though it's peaked and we could see it drop to possibly around about 2.2% in the next couple of months. But that does include some government energy subsidies. And of course, that's helping to keep it lower. Exports are starting to improve, and it's probably going to be worth watching for Japan's PMIs when they're released. So, inflation, it's likely to continue to be a little bit mixed at the moment. I mean, it's been coming down very well, but then we've still got this increase in geopolitical tension that's driving through. And of course, that in the Red Sea area, there's lots of inflationary pressures that could come from shipping disruption, and that could increase food and energy prices. So, and it looks as though the Red Sea situation, could continue for some time, and possibly even other countries enter the conflict. Of course, there seems to be more and more companies that are telling their ships to avoid the Suez Canal, and that's adding time delays to deliveries of more than 2 weeks. And also water levels in the Panama Canal, they're well below sort of their seasonal levels, which could lead to limiting the amount or actually the size of ships that's allowed to use that as a shortcut. So, a lot of these deliveries, these shortcuts seem to be a problem at the moment. And, if everything has to take the long way round, then that increases costs for the shipping, the ships themselves, the staff. There's even potential damage to some of the produce that may be on board those ships. Some of that may not actually be worth having by the time it gets to wherever it's got to go. So there's plenty that can go on there, and of course, when we look at that, it sort of, if there is an impact and we start to see food inflation coming back in, possibly energy inflation as well, it tends to take at least a couple of months for that to impact the data. So expectations of cutting rates is sort of, I just don't think that they can at the moment because the risk of doing that too early, if you sort of look through history, there was Arthur Burns moment. So he was the Fed chair in the 70s and he cut rates. And then the Fed was ill prepared for the second round of higher inflation that came after that. So, that could have been consumer demand, whereas here we've got sort of lots of geopolitical tension in play. So, and I think, I know this is why I keep arguing that the central banks will need to see inflation level off, around that target 2% level for a minimum of 3 months before they're going to cut rates. Just remember, that's just my personal view, but I've been saying this since last year that, for me, it's just logical. Whether that's the case or not, I don't know. Okay, moving on just a little bit. So many global leaders are sort of considering the implications of a Trump victory at the end of this year in the US and what that's going to mean for them. Of course, in the meantime, Biden's going to do his best to convince everybody that he's the best president and that he should remain so. And he's forgiving almost $5 billion in additional student loans. That's for around about 74,000 graduates. So, well, maybe that's 74,000 votes he's going to gain. But of course, he's going to be hoping that inflation drops before the election, so the Fed can cut those rates, which may sway some voters and help him to have a closer contest with Trump. Now, in the UK, retail sales they surprised to the downside, which is a surprise. When you think about it, over the Christmas period, usually the UK, where I'm based, is one of those areas that spends. But to a degree, that's probably going to be a pleasant surprise for the Bank of England. But of course, as we see around most of the world at the moment, that inflation still remains too high. And in the UK, we've got wage increases still moving along at a sort of a higher pace, although mortgage rates have started to drop in anticipation of those lower rates. That again, can sort of tend to give things a little bit of a boost, and even house prices have started to creep up again. So I suppose on the downside of that is going to be that there's sort of lots of borrowers that will be coming out of their sort of fixed loan period or their fixed loans completely, and if they've got to sort of continue or reschedule that loan in any way, then those repayments are going to increase considerably. Yeah, I think for mortgages, the banks will be sort of sensible and just extend the length of the time for those loans. But even so, you'd have to expect repayments to go up, and that is going to obviously reduce disposable income. Now, in Canada, inflation came in higher than expected again, and that's likely to prevent the Bank of Canada dropping rates at their meeting next week. And indeed, they have been warning that if inflation remains stubborn, that they could still have to increase rates. So, they're definitely not convinced that it's time to cut yet. And of course, that impact of higher rates is still feeding into economies and households around the world. We've yet to sort of feel the full impact of it, I would say, because it's sort of very lagging as that feeds into the economy. Now, the Canadian economy is shrinking, and that's reflected in sort of like the jobs data, and you could see job offers and jobs themselves shrinking by the end of the first half, I think. Now, next week we've got plenty of companies reporting. That includes Microsoft, Tesla, INTC, Netflix. But I think the main focus is going to be PCE, but also US GDP is out as well. So Bank of Japan's meeting is likely to be uneventful, and traders will be keen to hear any forward guidance from the ECB. Although, as I say, I just doubt that they'll be able to shed much light on things at the moment, just because of the geopolitical situations. Inflation was sort of moving in the right direction, but this could be a little bit of a hiccup. So, it's essential. Well, for me anyway, and if you're trading on a daily basis, I think it's essential that you have that real-time news to sort of help you control positions, and I do that. I mean, as pro traders, we've used them for over a decade, or well, probably a lot longer. The years go so fast, but we find it invaluable. And the one I use is Financial Juice. And the reason for that is because they've got the squawk, so it's like audio. So I can just listen to the news rather than have to read it and take my sort of attention away from the screen. So that saves me missing any of the price action, and I can react immediately to that. And they do offer a free trial, and I will add the link here so that just in case you're interested in checking it out. But you know, it's entirely up to you. But yeah, I mean, you know, you don't. Okay, so why do you need the news? Why do you need to hear it real time? You know, you might be in a good position and you might have your take profit in there. Well, if I hear some news and it's going to push the market in my favour, I want to get my offer or my bid out of the way and try and maximise my profit in that. If it's going towards my stop loss and I hear some news that's going to trigger my stop loss, I'll try and get out quicker because that's going to save me some money, and I might even reverse my position. So you know, there's a lot to be said for getting this real time news. So anyway, I just thought that was worth mentioning. Okay, so let's move on to the next part. Now, I just want to sort of just talk a little bit here about my services that I offer. So there's a daily newsletter that includes global news, headlines, my views, full articles. That is a subscription service. There's one-day workshops. You know, this will help you to discover if trading could be your next career or even just a second income. Uh, Otherwise, you know, maybe you're already trading, but you know, there's a few gaps that you'd like to fill in, and I can help you with that because that will accelerate your trading and your performance. And then there's a 1 week intensive course. You know, that's going to make you feel competent and confident after just 1 week. It's going to give you those foundations that you need to build your trading career on. And, you know, if you've got that in a trader, we'll find it. And now that does also include a free trading challenge. Then I do a Flexi Masterclass, which includes 6 weeks of guided learning. They can be split up, you know, you don't have to take them all at once. And this is designed to provide you with all the knowledge and trading tools that you're going to need to navigate any market and also on any asset class. You know, I trade them all. And as I say, you know, you can spread those weeks out over months if you need to. It's no problem for me. And again, that does include a free trading challenge. Now, trader mentoring, I'm doing more and more of this. And, you know, this is to help you reach that next level time and again. And, you know, I'm doing much more in the way of one-on-one sessions right across everything that I'm doing now rather than sort of looking for big groups. I do provide a lot of trader educational content to individuals, exchanges and brokers. And as you know, as I mentioned earlier about the trading challenges, you know, if you're looking for a funded trading account, then you know you can contact me for details just about the ones that I use, or you know you can sort of take one of the courses where I'll give it to you for free at the end of it. Okay, so then moving on to our disclaimer, just to make you aware that trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. And many companies provide leverage, so just be aware that you can lose substantially more than that initial investment. Everything I include in here is just purely for educational purposes. I'm not trying to encourage you to trade or invest. That must be your decision. And of course, you know, before you make that decision, you've got to consider the risks involved, definitely your financial situation, your level of experience, and your risk appetite. And of course, it's important that you only risk capital that you're prepared, but also that you can afford to lose. And if you've got any doubts whatsoever, seek independent financial advice and do that before you risk your capital. So many people come and find me after they lost money, which is sad. You know, they should come to me before. And yeah, so listen, that's it for part one. I hope to see you in part two, where I'm going to do some technical analysis.